Hey guys, welcome back to another video of Stonks Maxxing, day 136. Today I'm gonna prep my confluent pitch, so both the model and the pitch itself. Let's take a look. I think I might, maybe we'll open up Substack and then also create a pitch on this. Dashboard. I need post, text post. I'll do confluent. Data streaming as a service. Okay. So I think this is the model we had cooked up beforehand. So we're forecasting about 10 years of data here. And let's take a look. So operating expenses, I'm gonna do this for now. Let's take like a 50% operating margin. Let's do 10%, right? I don't think a lot of companies have 10% operating margin. So let's take the total revenues and multiply it by this, and we will get this number. Profit before tax. Okay, let's do 20 maybe. And then do 10% income margin. There we go. Okay. And then from here, so free cash flow, I guess we just define it usually as the net operating income, or I guess net income. Then I guess you could go from net income or net operating profit after tax, and then subtract sort of your net capex, and then subtract any changes in net working capital, non-cash net working capital. That should give you kind of your free cash flow. In this case, free cash flow to equity, maybe it'll be interesting to use like a free cash flow. We'll start from net income and then take the net operating cash from operations and then just subtract capex, and that should give us sort of this free cash flow number. I do think if we go to SEC Edgar, hmm, 2021. Oh, confluent. Filings. Maybe if we go on here, take a look at annual filings. Okay. Can maybe get the cash flow directly from Okay, consolidated balance sheet, operations, comprehensive loss, cash flows. This is very nice. Okay. Yeah, I'm gonna just add the cash flows here. Okay. Oops, wait. Wait, what the hell? I don't know why. Let's maybe get this view. So I have this freeze panes thing going on. Okay, let's try this again. So let's go back to freeze panes. All right, view. Depreciation and amortization. Accounts receivable. Okay, I guess we could just take this number, really. Depreciation and amortization. So it seems like this depreciation is starting to ramp up a decent amount. Net amortization of discounts. Premiums on marketable securities. I'm not too sure what the negative part means. Amortization of debt issuance costs. Okay. And amortization of deferred contract acquisition costs. Non-operating lease costs and lease abandonment charges, common stock-based compensation. Okay. I think just based on that alone, stock-based compensation was about 349. So instead of paying their employees with payroll, it's or cash, I guess most of it is stock-based compensation. Deferred taxes. Okay, so accounts receivable went up, so this affected the working capital. Deferred contract acquisition costs, not entirely sure what that is either. Accounts payable. Went down. So there was a cash outflow, accrued expenses and liabilities. Okay, net cash flow from. So I guess all of it is really OpEx stuff right here. How the company itself needs to be. Right. Needs to run, I would say. change. Oh wait. So it does seem like, oops, deferred revenue, call it total operating. Net change, total change in net working capital. Okay. I guess they can capitalize the internal use software costs. But yeah, this seems like a very CapEx light heavy, or I guess CapEx light business. And it seems like what they're doing is also just basically churning out their marketable securities. So cash flow for investing, trying to, I guess, harvest some of that 4% interest that the company should be able to get on treasury yields. $2023, so it's less in CapEx. I guess less spending on CapEx, and less spending on marketable securities. I have underwriting discounts and commission. Okay, oop, shit. Okay, so yeah, where did most of the cash come from that they weren't using? I guess maybe this then? Actually, I wouldn't say so. Yeah, beginning of period. So right after the IPO, they were also able to get a decent amount of I'm looking at my cup, and it does seem like there's like crust on the end. I wonder then, what are the maturities of the marketable securities on this company? $2021, right? Okay. Just a little bit less, it's not too bad. Okay, so it does seem like redeemable convertible preferred stock. Okay, so I guess all of the convertible preferred stock got bought out during the IPO, or they converted it to, I think they probably just converted to common shares. Consolidated balance sheets. Yes, this is a very asset-light business, it seems like, which is nice. Very little debt as well. It's like most software companies. Marketable securities, 2023. I think I have this flipped around. Yeah. Okay, marketable securities. Total current assets plus the hell? Okay, so liabilities, let's do accounts payable. Stockholders' equity, okay. So no wonder it looked a lot smaller. So they have Class A and Class B. It doesn't seem like there's lots in Class A or Class B. Okay, commitments or contingencies. So preferred stock, there is nothing. $2,149. So 21439. Okay, so current liabilities, accounts payable, accrued expenses, and other liabilities. Doesn't seem like this company has much debt at all. Maybe some accounts payable. I'd imagine that could be for like cloud cost, operating lease liabilities, maybe for an office building that they have. That is a decent amount actually. Operating lease liabilities of 290 and 330 million. I don't know how long it's gonna be. It's current, so 290, 330. The company itself makes, I think this previous quarter was 250 revenue. So it's about $1 billion run rate. I guess when it comes to the operating lease liability. Maybe actually building or paying for the office building is kind of like 25% of the company's cost, which is a decent amount. Deferred revenues though, about 424, so about 487. The operating lease liability is even greater now, 250. Okay. At 330, so that's about, it's like a third of revenues, the current run rate. Operating lease liabilities, non-current, deferred revenue, non-current, convertible, senior notes. Okay, this is actually a decent amount of deferred revenue, non-current. Okay. Yeah, I think this is actually pretty strong. 118, 188. We'll call this 1.08 billion or $1,088,000,000 worth of deferred revenue, which is non-current. Convertible senior notes. Say they did borrow a bit more debts. That's also convertible. Additional paid in capital accumulated deficit. Okay. I do want to take a look then at, oops. Let's see if we can find maybe this 2024 to 2022 fiscal year. Let's also see how the stream is doing. Okay. I knew this was going to happen. I should have checked earlier. Okay, nice. Consolidated balance sheets. Let's take a look, see if this number is the same. Other assets, non-current. Total current assets. And 14 property and equipment, goodwill, and intangible assets. Okay, so I guess they made an acquisition then. 2023. Yeah, that makes sense. Current liabilities, accounts payable. Okay. Accrued expenses. Operating lease liabilities, deferred revenue, liability for early exercise of unvested stock options. I would imagine that probably does not. How does that even affect? This company, right? Liability for, I don't know. Convertible senior notes, deferred revenue. Okay. So this is actually, let's do this. So this company does have actually a decent amount of debt. Liability for early investments. Maybe I'll just do this. No commitments or contingencies. 7591. equal plus total liabilities. Check. Okay, nice. Also, so debt to equity, it does seem like there's actually a decent amount of debt. Call, so senior convertible senior notes, right? And then deferred. Maybe operating lease liabilities. Let's do operating lease liabilities, and then plus current lease liabilities. Okay, so it's deferred revenue. That was 220. Right, that makes sense. That makes sense. That was 30% of company. I guess the operating structure would just be too much. Okay, so debt to equity. Divided by, oops. Total debts. By equity. It's about 1.3. I don't think the interest expense is that much though. Okay. Maybe I will add the balance sheet here. So free cash flow, net operating cash. I want to take a look inside your annual report. See what is in this capitalization of internal software costs. I don't know if I can find it. There's just three items, Control F, but also maybe marketable securities. $64.2. Okay. customer represented 10% or greater of total revenues. Okay. Hmm. Okay, this is interesting. This software development cost. Oh shit. Software development costs for software to be sold, leased, or otherwise marketed are expensed as incurred until establishment of technological feasibility, at which time these costs are capitalized until a product is available for general release to customers, and amortized over the estimated life of the product. Okay. So I wonder where it is then on, so maybe it's total assets, marketable securities, operating lease right of use assets, deferred contracts. Maybe it's this, goodwill and tangible assets. Other assets non-current. Yeah, I don't know where they add it on the balance sheet then. Oh, okay. So costs incurred during the application development stage are capitalized within property and equipment, net on consolidated basis. Amortization is computed using the straight line method over the useful life. Okay. Oops. Maybe I'll. Useful life. So remaining estimated life is property equipment. Excuse me. Okay. So software only has a 3-year useful life, which is interesting. Income expense net on the consolidated. Okay. Payments for its term-based base license annually. Does not necessarily represent the total contract value. Okay, but I find this probably less of a less so of a convincing measurement. I think the deferred revenues, because if Confluent is operating on a consumption-based model, then I don't think a lot of people will use these term-based licenses, right? Okay. Generates revenue from the sale of subscription and services. Subscription revenue consists of revenue from term-based licenses that includes post-contract support, maintenance, and upgrades, referred together as PCS, which the company refers to as the Confluent platform, and the company's SaaS offering, which the company refers to as Confluent Cloud. There's the company, Confluent Cloud may purchase subscriptions either without a commitment contract on a month-to-month basis, which the company refers to as pay-as-you-go, or under a usage-based commitment contract of at least 1 year in duration, in which customers commit to a fixed monetary amount specified per usage rates. Revenue from the company's pay-as-you-go arrangement was an immaterial portion of subscription revenues during the year end. Okay. The company primarily enters into subscription contracts with 1 year terms, and subscription contracts are generally non-cancelable and non-refundable, though customers can terminate for breach if the company materially fails to perform. Services revenue consists of revenue from professional services and education services. The company generates sales of its subscriptions and services. Okay. Professional service and education services. The company generates sales of its subscription and services through its sales teams, self-service service channel, and partner ecosystem, including the major cloud provider marketplaces. Contract customers. Within its customers, obtain principal of promised subscriptions or services in an amount that reflects the consideration that the company expects to receive in exchange for those subscription or services, determining the appropriate amount of revenue to be recognized. Through order forms, which are governed by master sale agreements, and through cloud provider marketplaces, the company determines that it has a contract with the customer when the contract is approved. Each party's right regarding the subscriptions or services to be transferred, and the payment terms for the services can be identified. As commercial substance, the company applies judgment in determining the customer's ability and intent to pay, which is based on a variety of factors, including the customer's historical payment experience, credit, financial. Okay. Total amount, company, variable consideration, including transaction price, if probable significant. Okay. What is SSP? Post-contract support. On a usage basis. Okay. Company subscription revenue also includes revenue from Confluent Cloud for its usage-based commitment contracts and pay-as-you-go arrangements, which is recognized on a usage basis, as usage represents a direct measurement of the value to the customer of the subscription transferred as of a particular date relative to the total value delivered over the term of the contract. Okay, so I think this is just a really winded way of saying they charge people based on a consumption business model, and they'll recognize something as revenue once you've consumed, let's say, a unit of Kafka service. On a time and materials basis, services, okay. Personnel related clause, salaries, bonuses, benefits, stock-based comp for employees associated with customer support and maintenance. Customer support and maintenance, third party, cloud infrastructure costs, amortization of internal use software and acquired intangible assets, okay, and allocated overhead. So cost of services revenue primarily includes personnel related cost, including salaries, bonuses from associated with professional services and education services, costs for third-party consultants and partners who supplement our services delivery team, and allocated overhead. Okay, so R&D costs, expense as incurred, and personnel-related costs. Okay, so that's just payroll, bonuses, benefits, stock-based comp, net of amounts capitalized. Third-party cloud infra, current developing software dedicated for use by the company's research and development organization, contractor and professional service fees. Okay, so I think they mentioned specifically this line item of advertising cost. So they broke this down, which is nice. 27700, 27 million, right? This would be nice to do percent of revenue. Maybe the same here. Okay. So this is where, yeah. So sales and marketing is really where most of the costs are coming from, it seems like then. Okay. I'd imagine this is probably with their sales team. Maybe this is... So Black-Scholes to value the restricted stock units. Less than 12 months, 12 months or greater. Okay, so a lot of contractual maturities, companies, marketable securities. Okay. Currency forward contracts. I don't even know if I want to even look at this. I feel like it's not super helpful. Okay, let's take a look at the balance sheet then maybe. The balance sheet build. The balance sheet build. Computers, equipment, software, furniture and fixtures, leasehold improvements, capitalize internal use software costs, construction progress, capitalize internal use software costs, total gross PPE less accumulated depreciation, PP&E net. So net PP&E. Seven nine four 977-458-25-629 5404. Three eight 999 7831. So we have 2514 12183. So 54012, which is nice. Okay. So this is kind of our net PP&E, computers, equipment, and software. So that number's increased by about 3 million. I think the capitalized software, it's increased by a decent amount here. Yeah, about 14, give or take, $14 million. construction in progress, capitalize internal software costs. I actually don't know what the difference is between these two numbers. Leases. Minimum lease payments, purchase obligations. Yeah, so this is pretty. Yeah, I guess we'll call this pretty substantial in terms of the information they give us. Probably should model things as a percent of whatever. Okay, let's take a look here maybe. So, unfreeze panes. Subscription mean estimates. Okay, I wonder, I guess for this it would be helpful to get the estimates. Okay, confluent. Maybe the annual estimates. That'll be pretty good. Let's take a look. What time is it? 8:19. Let's go. Okay, so cost of revenue. Maybe we'll do like a percent of revenue. So it does seem like a decent amount here. Boom, boom, boom. 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 J48, JJ48. Yeah, I don't think we need the sequential growth, but maybe a percent of revenue growth. That would be nice. Oh wait, percent surprise, yeah, that's good. Yeah, so we think this is gonna continue to become a slower and lower portion of revenue, but Confluent Cloud is really gonna drive revenues in the next few years. Right, consistent with what I think management is thinking, and I think what the overall trend is in the business here. Yeah, 119. Circle actuals. I gotta multiply all of this shit by 100. It's 1,000, right? Okay, let's do currency. Oh shoot. So they think that this could probably grow another 20%. Oh wait, let's do this. So we'll also do like, I think potentially 46%. Times 1 plus oh wait, I think I got the numbers switched around. %, let's do like 16%. %, 31%. Okay. So 50%, 31% growth might be a bit unreasonable. Maybe. I think if you look at Pound here, right now they're trading at, I think like a 60x revenue multiple. So even with 26% growth, I guess at that level is still pretty solid. $40 minus 1%. Can you grow at 31%, 30% for that long? I don't know, actually. That seems like a lot. But 14 million in subscription revenue. Okay, what's like the average? Companies. Let's just say like 10% maybe. Okay, 2024. So cash flow statement. Oh, Palantir. That's what I say. It doesn't look right for confluent. Sure. Man, really? Okay. So I guess analysts expect to go cash flow positive this year. Makes sense. Percent surprise. Oh wait, I gotta do this. Minus one. Yeah, actually, I don't know if this is a good metric, that percent surprise thing. It's negative 19%. Yeah. I think this is pretty low to compare. About 200. Oh, 2 billion. No. Wait, if that's the case, I think then the analysts are estimating in just in the next 3 years. It's 2% of revenue. You could do mean estimates divided by, actually it's this. And 40,500,9. Okay, so I have to be realistic here. .9. It's 2 points. Terminal year. Yes, this was like 80, like 90 million, 100, wait. 28, and 80, 84, 145. So it's almost doubling every year. It's like 200. Yeah, I guess maybe this, by doing so this way, we might be missing out on cash flows that the company might bring in. Or it might be, I think it might be undershooting the stock price. If I guess we're undershooting the cash flows. Let's do share, terminal growth. 2%. Cost of equity of 15%. It's fine with me. So terminal year is equal to plus 2% divided by 10 minus by the cost of equity here. Yeah, just $9 per share. Oh god. So what if we do 3%? That's it. Right, 10%. Okay. Damn. Okay, so these cash flows really need to ramp if we want us to hit this price number here. Let me take a look. I think this is a question I have for ChatGPT. Do DCFs tend to undervalue growth companies? Maybe this is more so of a philosophical. Yeah. Hmm. Okay. I like reading these. This is kind of fun. Okay. Okay, I'm gonna go grab some water real quick. Another philosophical deep dive into the process of using TCS. Yeah. Let's go like 3%. Excuse me. But let's increase this to if we double it each year. 25 billion. Yeah, it's not probably not gonna happen. Okay, 1.5. 3 billion by that year. Okay. 1.75. What do we need to get, right? Okay. So 4 billion in free cash flow by 2035. Is that possible? What do we have forecasted in? Hey, it's doable. It's doable. Massaging the numbers. Massaging the numbers. Okay, I'll be back in a sec. You see how this stream is going? Alright, not bad, not bad. so now that we have this, I think another thing I do want to take a look at is, so we'll call this model comps. All right, so we have Palantir. So Palantir, Snowflake, MongoDB, HashiCorp, maybe, Cloudflare. Oh, and then Elastic. Maybe you could go here, so 2021, 2022, 2023. So revenue. TR. Okay, I might need to open up, oops. I might need to open up my other sheet for this, cloud software. Or maybe just this is good. RDP.data. Oh, wait. Is it and? Is that what it is? Workspace, resume updates. Okay, I have to find. Data infra couchbase. Okay, C3 rubric. I guess I'll add all of these then. Mongo dot. Wait, Mongo DB. Palantir. Let's see. Forecast. I guess we'll have to change this on Monday. That's when I think Palantir reports earnings. Okay. Period is equal to question mark. Oh, okay. Should we do mean or median? This is a crazy number. Okay, even that is pretty high. I'll just leave it with mean for now. Okay, so D4. Or okay, that's a lot. 69%, 35%. Okay, so 47%, that's actually a decent amount. Here's what do Couchbase, Confluent. Very curious about Elastic. Okay, so this. Hmm. Yeah, I don't know what's going on in 2027 that's warranting this 66% increase off of 4 billion revenue base. Currency. Okay, so Elastic, let's try that. D12. Okay, so it's surprising that CFLT. CFLT, okay. Oh. Yeah, maybe I'll... $181, 776. Oops. $17. Oh, 7. Okay. So 20% all the way up. Let's see it. Does it go further than this or no? No, it's not. So 5 years. So 20% growth for the next 3 or so years. That's what analysts are expecting across a lot of these companies. I think Snowflake is a company where it seems like highest growth out of all of these. But Palantir is still pretty high. I don't know what is the 66% in 2027. Maybe it's worth exploring. Maybe. Wait, what is it? 2027. Okay, so there's one guy that's doing it. That's probably why then. 2026. Okay, so maybe. I guess it just went public this year, right? So makes sense. I guess I won't include it for now. Okay, let's take a look then at operating margin. Shit. Okay. D16. Oh, I guess I should have kept it all. Okay. Yeah, I think maybe this 21% growth Maybe analysts are undershooting the potential revenue growth here. I could be wrong, but they do think Confluent's going to grow less than Snowflake, MongoDB. Yeah, maybe not as much as MongoDB, but even off of a higher revenue base, I feel like right now analysts aren't thinking Confluent has the ability to grow as fast. Okay. Operating margin. It's RDP. Data. I guess actually what we might be able to do is just copy this. Just formula builder. Okay. So I think the main ones to consider here are kind of like the operating margin and then free cash flow margin. Yeah. I don't know if there is a margin then. Gross profit margin. Yeah, let's do operating profit. Oh, profits actual at value. What the hell? It's null. Okay. Profit. So what if I try this then? Okay, so even this doesn't even work. Actually, I feel like I do have good stuff here too. Okay, maybe not. Oh, revenues. Okay, yeah, maybe not. What about this? Free cash flow, actual value. Okay, I'll take this. It's still free cash flow negative MongoDB, which is interesting. Free FCF mean. My let's see, D30. My thinking is maybe analysts are also maybe a bit over optimistic about whether or not these companies can generate free cash flow in current quarter, or I guess in the year. Couchbase, base.o, c3.ai. Description. Yeah, we can merge all of these cells together, hopefully. Merge. Merge. Okay. Salesforce. CRM. So D9. Oh, this is it, this is it. Okay. See. Oh, okay, interesting. I feel like Salesforce did not, but screw it. Okay, wow, so I didn't realize that Salesforce was able to still grow at 25% year-over-year revenues, which is not bad at all, considering it seems like a 20-year-old company. Huh. I'm like trying to grasp the last few sips of water. Okay. So free cash flow. Take this away. Bow down and down, down. Bow down, boom, boom, boom. Down, 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 you again. Bow, 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 see you again. Going crazy, I'm going crazy, I'm going crazy. I'm going crazy, okay. Let's go. Okay. Oops. Wait, does Salesforce really report? Okay, nice. Wait, I feel like this is less than what our estimates over here are. I think net cash flow from operating activities. I think that was $28 million. So this is only 7. Got it. Salesforce is pretty crazy. And 29% off of that? That's insane. Off of $4 billion. I think if we look at Salesforce's stock, I mean, pretty sure it just goes up. $8,000. It's 80x since 2004. About 21 years then. Very interesting, very interesting. Okay, so I think I'm gonna stop here for now. I wanna go for a run, potentially get something to eat, and then I'll come back and stream. So thanks for tuning in for now. I think we made a decent amount of progress on our model here. I think what I'm trying to do here is figure out, okay, what is the analyst / market thinking with a bunch of these companies here? Maybe see where we are in the market for the multiples of all of these companies. I think that would be interesting to take a look at. And then also start on the confluent write-up. I think that's going to be very important. Okay. So with that, thanks for tuning in. Catch you guys next time. Peace. Oh, I gotta actually exit from here. All right, see ya.